Hello, everyone. This is Mike on Money with your tactical update. This is the end of December 2024 update. So we're going to actually kind of take a look at the year as a whole. So it'll be a little bit longer video today. We've got a lot to cover. We've got obviously the year end. We've got December's eye opener for the markets and a little bit of look into 2025. As always, my name is Michael LeBlanc, Senior Portfolio Manager with LLC Private Wealth and CG Wealth Management. Thanks for joining me. Keep in mind, all the information we cover on these videos is for information purposes. Always do your own due diligence or reach out to us for any information about your portfolios here with us, or if you have any external portfolios, we're always happy to answer any questions and help out any way we can. So let's take a look at 2024. Overall, 2024 ended on a great year, a great performance year. We really liked how the portfolios performed. The tactical approach took advantage of some really great gains during the year without overexposed into too many of the sectors that were outperforming, but we managed to keep up in a lot of the categories for the performance. I'm not going to go into detail on performance numbers because we always run into everyone's portfolio. Remember, we take a very tailor-made approach for your portfolios. So whenever I say a number, compliance departments are always, well, which one are you talking about? So if you go to our website, llcprivatewealth.com or .ca, or you can always go mikeonmoney.ca, it takes you to the same site, and you look into our insights. All our model portfolios are there with the updated performance, end of month updated number of portfolios, and of course it will have the December ones there for 2024. So go there to take a look at performance. Rather than me kind of get into details here. Needless to say, it was a great year. Although we will talk about December, since it is kind of wrapping up December here. It was a bit of an eye-opener. So there's some negativity in the markets in December. Some of the portfolios did see a little bit of a pullback, nothing major. And there's some broad pullbacks in a lot of the big growth sectors that we saw perform in 2024. And a lot of that came right after the Fed kind of announced that the US was doing their half-point cut, but the language turned hawkish as to how many cuts we were going to see in 2025 and beyond. So we basically went from, the expectations from the beginning of their cuts to the end was roughly 6. Now we might see 4, we might see less. There's even the possibility, we talked about this in the November video, that we might see some reinflation in the US, and we might even see, after maybe another cut or two, a possible raise, and that would come into play if the US reinflates. So what we've seen in December is that concern, that fourth quarter kind of reversion on the original macro outlook, that we were going to go into a steady year of cuts, inflation coming down in the United States, orchestrated hopefully a soft landing, and then re-stimulate growth. Now the language and the concern out in the market is definitely around the concern that we aren't going to see inflation really start to fall off like we've seen in Canada. Canada's actually we're several steps ahead on that front, and the concern is that they could actually reinflate, and that might come into play, as we mentioned last month, with the talks of using tariffs for income, basically tax. We talked about it last month. It's basically a consumer tax to Americans, and then that could definitely reinflate the economy down there and prevent more cuts. And again, the risk of possible a hike. Now, when I say a hike, I don't mean that 2-3 points like we saw in 2022, but more along the lines, even if we saw a quarter point hike and then another drop after that, just that up and down will reverberate volatility through the market, given the uncertainty for companies not knowing what their cost of capital is going to be, if we could possibly go into some hikes even in the shorter term. So that's what we've seen in December. Market's getting a little shaky on that. So obviously being concerned about the possibility that we're not going to see lower and lower rates in the United States, and that might mean problems. So what does that play into the portfolios? We did do a big rebalance in the portfolio, partially because of that, but mostly because the macro shift that we talked about, that reversion from from one outlook for the long term to the change. So you might notice in the portfolios our short term basically cash equivalent. It's invested in high interest vehicles, but we went from a partial long-term exposure. So we had some long-term exposure on the fixed income side of things in the portfolios, looking at those rate cuts. We've shortened that up. Doesn't mean that that's our call. We just are taking a cautious approach going into January. Obviously, the new government's coming in January. There's going to be new heads of departments coming into the U.S. government in January. So we want to see that play out, because a lot is being said, but what actually happens is likely to be very different as to the language we're hearing out there. The amount of the tariffs, where the tariffs are going to be applied, what they're going to be doing with, different policies, different departments, and obviously the debt ceiling came up in December, and that's been pushed out temporarily, and there's a lot of infighting with the Republicans around that, and with Elon Musk, not sure why, but so there's a lot of things going on. So we're gonna have to see what actually plays out, and we're gonna see a lot more of that by the end of January, after the new government actually takes over. So we're just taking a bit more cautious approach going into January. We still have equity exposures. We have reduced US dollars exposure, and that's mainly because this disparity between the Canada and the US. Again, the Canadian interest rates continue to get cut because our inflation is very, very low. In fact, the question is now, are we actually in a recession in Canada, and when we might come out of that, or are we going to skirt the recession completely and have a soft land? And I think we might skirt into a short recession. But anyway, that's causing the spread between the Canada and the US dollars. And that's going to continue. Don't look for the Canadian dollar to rally back in the shorter term, for sure, until we start to see that inflation number in the US and those rates in the US to start to come down again. So we're taking advantage of that spread, moving some US dollars into Canadian, and when that trend reverses or starts to reverse, we can take advantage again of that trade moving back to the US dollar. So that's been happening in December in the portfolios, and that's why you're seeing the portfolio is a little bit more conservative stance, but most of that is being driven by shortening up the duration in the portfolio. It's not a run-in from the market. We still have very, very good equity exposures. We have trimmed all through 2024 from our better performing positions, and we did a little few further trim in December before year end to take advantage again of those gains and a bit of that uncertainty going into January. So let's take a look at 2025. Overall, nothing much has changed. We are still focused on consumer staples. Consumer staples, of course, are your grocery items, your power companies, things people generally prioritize spending money on, and definitely moving away from what we call consumer discretionaries. Those are your cars, your high-end items, things people will put off purchasing because if they're nervous or concerned about the economy or about their jobs, or about what the longer term outlook is. So that macro shift we saw in fourth quarter 2024, we're looking into that into 2025 is continuing. So we're focusing on that. We put Magna into the portfolio, which is a Canadian auto part manufacturer. So people repair their cars, they're just not buying new ones. So we're staying away from the discretionaries, focusing on those utilities, focusing on the consumer discretionaries. We still love the Canadian financials. We have a healthy exposure that's been all through 2024. It's paid off really, really well. We continue to maintain that exposure. As I mentioned, the big move we did is shorten it up. So we took out that 20-year US bond position from the portfolios, and we took it back to short term while we reassess things here in January. So that's pretty much it for 2024. It was a great year. Everyone should be, hopefully, you're very happy with the performance of the portfolios. We certainly are. If you want to know directly what you've done, by all means, give me a call. If we haven't talked to you in the last little bit, we're happy to share that with you. As I mentioned, you can go to our website, and those updates are published every month. Usually go out after about a week into the new month. It takes about a week for our compliance to audit the numbers before they're approved, but they're up there. And if you want help finding those, we can send them to you or direct you where you can find them on a regular process. So with that, I will say, I guess, end of 2024. Happy 2025. Looking forward to talking to you all and hearing from you all in 2025. And we'll see you next month. Thanks very much, everyone. Bye now.